What's up everyone, it's Billionaire and welcome back. Today we're diving into the mind of Warren Buffett to understand when he might consider selling a stock. Buffett is famous for his long-term investment philosophy, famously saying his favorite holding period is forever. But that doesn't mean he holds on to every stock indefinitely. There are specific situations where even Buffett sees more value in selling. So if you're ready to gain some valuable investing insights, hit that like button, subscribe, and let's get started. Let's talk about the first scenario where Warren Buffett might sell a stock. This happens when the fundamentals of the business take a turn for the worse. Buffett invests in companies with a strong economic moat, meaning they have a durable competitive advantage that sets them apart from competitors. But what happens when that moat starts to shrink, and the company's edge begins to erode? That's when Buffett starts paying very close attention to the details. Imagine you invested in a company that dominates the market for a specific product or service. They've got a great brand, loyal customers, and a well-oiled operation that seems unstoppable. But then, something changes. Maybe a new competitor emerges with a superior product or a disruptive business model that shakes up the industry. Maybe the company's management makes a series of bad decisions that erode its competitive edge and market position. Or perhaps the entire industry undergoes a fundamental shift, such as technological advancements or regulatory changes that puts the company at a disadvantage. In these situations, Buffett meticulously analyzes whether these negative changes are temporary setbacks or signs of a permanent decline in the company's prospects. If he believes the company's long-term prospects have deteriorated significantly, he won't hesitate to sell his shares. Remember, Buffett is pragmatic about protecting his capital and maximizing returns for his investors. He's not afraid to cut his losses and move on if the original investment thesis is no longer valid or if the company's future looks bleak. Let's take a real-world example. Tesco, the British grocery giant, which faced significant challenges. Back in 2014, Tesco faced intense competition, an accounting scandal, and changing consumer habits that affected its business. Buffett, a longtime investor in Tesco, decided to sell his stake, admitting he had misjudged the market and the company's future prospects. This move highlighted Buffett's commitment to selling when the fundamentals deteriorate, even if it means acknowledging a mistake and learning from it. Always keep a close eye on the companies you're invested in, monitoring their performance and market conditions. If you see signs that the fundamentals are deteriorating, don't be afraid to reevaluate your investment thesis and make necessary adjustments to your portfolio. Now let's talk about the second scenario where Warren Buffett might sell a stock. This scenario occurs when the stock price becomes significantly overvalued compared to its intrinsic value. You might be thinking, isn't the whole point of investing to buy low and sell high? And you'd be right. But Buffett doesn't just chase price increases, he has a more nuanced approach. He's focused on buying great businesses at reasonable prices, ensuring that the value he gets is worth the price he pays. Or as he famously puts it, price is what you pay, value is what you get. Sometimes, due to market sentiment or investor hype, a stock's price can become inflated, exceeding its intrinsic value. When this happens, Buffett becomes cautious. He knows that an inflated stock price can be a red flag. He understands that buying an overvalued stock means paying a premium for future growth that may not materialize. It's like buying a house for $1 million when it's only worth $700,000. You're setting yourself up for potential losses. Now, Buffett isn't afraid of short-term price fluctuations. He has a long-term perspective. He's famously said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. He understands that the market can be irrational in the short term, but eventually, a company's true value will be reflected in its stock price. However, if a stock's price becomes excessively detached from its intrinsic value, even Buffett might consider taking profits. This doesn't mean he's trying to time the market. It simply means he's disciplined about selling when the potential rewards no longer outweigh the risks. For example, during the dot-com bubble, Buffett avoided investing in tech companies, recognizing that many were significantly overvalued. When the bubble burst, many of these high-flying tech stocks crashed, leading to significant losses for those who had invested in them. Buffett's decision to avoid overvalued stocks protected his capital and allowed him to capitalize on better opportunities later on. The key takeaway is to be wary of chasing hot stocks or getting caught up in market hype. It's essential to stay grounded in the fundamentals. If a stock's price significantly exceeds your estimate of its intrinsic value, it might be worth considering taking some profits. Always remember, disciplined investing is about balancing potential rewards with the risks involved. Now let's talk about the third scenario where Warren Buffett might sell a stock when he identifies a more compelling investment opportunity. This is a critical aspect of his investment strategy that often goes unnoticed. Buffett is a big believer in concentrated investing, meaning he prefers to own a relatively small number of stocks that he knows and understands deeply. This approach allows him to focus his resources and attention on businesses he has thoroughly vetted. He famously said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." This quote encapsulates his belief in the power of deep knowledge and understanding of one's investments. However, even within his concentrated portfolio, Buffett is always on the lookout for exceptional businesses that offer greater potential returns. He constantly evaluates his holdings against new opportunities that may arise. If he stumbles upon such an opportunity, he might consider selling a portion of his existing holdings to free up capital. This is a strategic move to ensure that his portfolio remains optimized for maximum returns. This doesn't mean Buffett is constantly chasing the latest hot stock. He avoids the temptation of short-term gains and focuses on long-term value. He's extremely selective and patient, only making a move when he's convinced that the new opportunity is truly exceptional. This disciplined approach is a hallmark of his investment philosophy. A great example is Buffett's investment in Apple. This decision marked a significant shift in his investment strategy. For years, Buffett shied away from investing in technology companies. He was cautious about industries he didn't fully understand. However, in 2016, Berkshire Hathaway began purchasing Apple stock, and it has since become one of its largest holdings. This move demonstrated his ability to adapt and recognize value in new sectors. In Apple, Buffett recognized a company with a durable competitive advantage, a powerful brand, and significant growth potential. These factors aligned with his investment criteria. Despite his historical aversion to tech stocks, Buffett recognized Apple's exceptional qualities and was willing to allocate a significant portion of Berkshire's portfolio. This decision paid off handsomely. This scenario highlights the importance of adapting and evolving your investment strategy as market conditions change. Flexibility and openness to new opportunities are key to long-term success. While it's important to have a clear investment philosophy, it's equally crucial to be open to new ideas and adjust your approach when necessary. Stagnation can be detrimental in the ever-changing world of investing. Investing is a dynamic process of continuous learning, adaptation, and optimization. By staying informed and flexible, investors can navigate the complexities of the market and achieve their financial goals. So there you have it. 3 key scenarios when even Warren Buffett might consider selling a stock: when the fundamentals deteriorate, when the stock becomes overvalued, and when a better investment opportunity arises. While Buffett is renowned for his buy-and-hold approach, these scenarios demonstrate that he's not afraid to make a move when it makes sense. Remember, investing is not about blindly following any single investor. By studying the strategies of great investors like Buffett, you can gain valuable insights and refine your approach. If you enjoyed this video, give it a thumbs up, subscribe, and hit the notification bell. Until next time, happy investing.